Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. We wanted to go through some of the charts and data points that have caught our attention the most in recent weeks. First, one thing we're assessing is that last low in the equity market in October of last year. We've just now gone past 6 months since that low. And if that really was the final low in the bear market, we would see certain areas of the equity market look very strong in the 6 months afterwards. So we've been looking and seeing what those areas have performed like since October. First, we look at small cap stocks, represented by the Russell 2000 index. If we look back more than 40 years, on average, after a bear market low, small cap stocks appreciate by 50% in value in the first 6 months. In this case, the Russell 2000 is only appreciated by 4%. Which tells us that something different is happening here. They're still having some weakness that they're sorting through, and this is not what we would anticipate if we had an all-clear signal that a new multi-year rally in the market has begun. The second area we look at is financials and banks specifically. If we want to look at regional banks most of all, typically going back 35 years off of a bear market low, regional banks would appreciate by 20 to 50% in the first 6 months after the low is made. But in this case, regional banks have actually gone down in value by more than 30%. So this tells us that regional banks and banks in general are not exhibiting the strength and reinforcing that return to growth in the economic environment that we would have anticipated had that low last year been the final low. This is having an issue with small businesses specifically. Small businesses during a period of economic growth are the ones that add the majority of new jobs in the United States. And they rely on regional banks for most of their loans that they take out to try and push their growth further in the future. With regional banks pulling back on their lending because they don't know if customer deposits are going to be able to stay at their banks, it's really hurting small businesses. And this chart shows that the net share of small companies that are having trouble getting new loans has hit a level that we've only seen 2 times in the past 35 years. Both were during recessions, 1990 and 2008. We've mentioned a lot of leading indicators for the economic weakness to come over the past 12 months, but we're also tracking lagging indicators because usually you'll see these start to deteriorate as well right at the start of a recession. A lot of this has to do with the jobs market. And this is one chart that we follow, continued jobless claims, which are reported weekly. When you see continued jobless claims increase by 7 to 12% on average versus the prior year's number, that's usually around the start of a recession. Right now, we're 13% higher than we were a year ago. We also saw a data point that the percentage of states in the U.S. that are reporting greater than 30% increase in continued jobless claims has just reached a level that in every previous case going back more than 3 decades led to a recession. And it usually led to at least 70% of the states will get to reporting continued jobless claims increases of more than 30%. How's the market reacting to this? Well, we're seeing a shift in the last 2 to 3 months away from cyclical sectors, which all have peaked in the last 1 to 3 months and are now going down, and towards defensive sectors like consumer staples, healthcare, utilities, and even gold and gold miners. Those areas have all been moving higher in the last couple of months. And when we look at a table like this, it looks like an early recessionary equity market. And it tells us to not try to rush in and anticipate where the new values are going to be. We probably have further to go. And when we look at some of the valuations in these cyclical sectors, they still look pretty fairly valued to us. So we're going to continue to monitor things closely, maintain our defensive stance, and we'll be very excited when some of these valuations reach really great levels for us, but right now we're still not seeing it yet, and we're going to maintain our defensive posture. If you have any questions about that, please contact us. If you like this video and want to stay up to date on our views about the financial markets, please subscribe below to our Oxbow Advisors channel.